Something unusual happened last week, something that hasn't occurred in 6 years. The Federal Reserve cut interest rates, and that part was entirely expected. But here's what caught everyone off guard. 3 members voted against it. 3 dissents. The people who control the flow of money in America, the most powerful financial minds in the country, cannot agree on what to do next. Some want lower rates to protect American workers. Others want higher rates to crush inflation before it spirals out of control. And here's the uncomfortable truth. Both sides have valid arguments. That's exactly why this situation is so dangerous. The Fed isn't just divided, they're stuck facing a choice with no good answer. Cut more, and you risk reigniting inflation. Hold steady, and you risk watching the job market collapse. This isn't some academic debate happening in a conference room. This is a warning sign flashing bright red. When the Federal Reserve splits like this, markets get nervous, investors get confused, and the economy enters deeply uncertain territory. Today, we're going to break down exactly what this means for you. We'll examine the real risks that lie ahead, risks that most people aren't talking about. And we'll explore how to think about your money as we head into 2026. Let me set the stage for you. On December 10, 2025, the Federal Reserve announced its third rate cut of the year, a quarter-point reduction that brought rates down to a range of 3.5 to 3.75%, the lowest level we've seen since 2022. Markets had priced in a 90% probability of this exact move, so the cut itself surprised absolutely no one. The surprise was the vote, and what it revealed about the deep fractures within the Fed. 9 members voted yes, but 3 members voted no. And here's where it gets fascinating. Those 3 dissenters didn't even agree with each other. One wanted a bigger cut. He pushed for half a point instead of a quarter. The other 2 wanted no cut at all. They preferred to hold rates exactly where they were. So you have 3 people publicly disagreeing with the decision, and they're disagreeing in completely opposite directions. One says, cut more aggressively. 2 say, don't cut at all. And Jerome Powell sits uncomfortably in the middle. Powell defended the decision, saying the Fed is now well-positioned to wait and watch. But his words revealed something deeper: uncertainty. He mentioned the government shutdown multiple times, pointing out that it had delayed critical economic data. Inflation numbers since October? Incomplete. Employment figures? Missing. The Fed made this decision while flying partially blind, unable to see the full picture of what's actually happening in the economy. This is the brutal reality of central banking. You act with incomplete information, you hope you're right, and then you deal with the consequences, whatever they may be, months or even years later. The consequences of this December decision will unfold throughout 2026. And by then, Jerome Powell may no longer be sitting in that chair. Now let's examine what's really driving this divide, because the Federal Reserve is not a single voice. It's a committee of individuals, each with their own economic worldview, each weighing risks through a different lens. Usually, that internal tension stays hidden behind closed doors. Members argue, debate, and occasionally shout at each other in private, then emerge with a carefully crafted, unified message. But not this time. This time, the cracks are visible for everyone to see. On one side, you have the hawks, members who prioritize fighting inflation above all else. They believe prices are still too high, and they worry that cutting rates is like throwing gasoline on a smoldering fire. Jeffrey Schmid is a hawk. He voted to keep rates unchanged. Austin Goolsbee joined him. Their logic is straightforward and historically grounded. If you cut rates too fast while inflation is still elevated, it rebounds. And then you face an even harder, more painful problem down the road. On the other side, you have the doves, members who see the labor market as the more pressing concern. They're watching job growth slow month after month, and they're deeply worried about unemployment creeping higher. Stephen Moran is a dove. He wanted a bigger cut, arguing that half a point was necessary to prevent serious economic damage. His logic is equally valid. If you wait too long to support the economy, the job market breaks, and then you're staring down a recession. Here's the crucial point that everyone should understand. Both sides are looking at exactly the same data, the same inflation reports, the same employment figures, the same economic indicators, and they're reaching completely opposite conclusions. That tells you something profound about where we are right now. The data itself is fundamentally unclear. The signals are mixed, contradictory, almost deliberately confusing. Inflation is elevated but not exploding. Jobs are slowing but not collapsing. We're stuck in a gray zone, and gray zones make central bankers deeply, deeply uncomfortable. Powell is trying to thread an impossible needle, delivering a quarter-point cut that's not too aggressive, not too timid, the Goldilocks approach. But 3 of his colleagues publicly disagreed with that choice, and their disagreement sends an unmistakable message to anyone paying attention. The Fed doesn't know what comes next. They're guessing, just like the rest of us. And when the experts are this divided, certainty is nothing more than an illusion. Now, you might be wondering, why should I care about 3 dissenting votes? It sounds like inside baseball, a technical detail that only economists obsess over. But history tells a very different story. The last time 3 members dissented from a Fed decision was September 2019. Think carefully about what followed. Within 6 months, the entire world changed. A pandemic swept across the globe, markets crashed in spectacular fashion, and the Fed slashed rates all the way to 0. I'm not predicting another crisis. That would be foolish and irresponsible. But the pattern is worth noting. Internal disagreement at the Fed has often preceded major economic shifts. Here's why dissents matter so much. The Fed works hard to speak with one voice because unity signals confidence. It tells markets that the smartest financial minds in America agree on the path forward, that there's a plan, that someone is in control. When that unity fractures publicly, confidence erodes, and it erodes fast. Investors start asking uncomfortable questions. Is the Fed losing control? Do they know something we don't? Are they worried about risks they can't discuss openly? These questions breed volatility because markets hate uncertainty far more than they hate bad news. Bad news? You can price, you can adjust your portfolio and move on. Uncertainty? That's something else entirely. When the Fed itself radiates uncertainty, that uncertainty spreads like a virus, infecting investor behavior, changing corporate decisions, making everyone more cautious about taking risks. There's another dimension to this that makes it even more significant. Powell's term as Fed chair ends in mid-2026, probably May or June. President Trump has made his feelings about Powell crystal clear. He's called him names, criticized this rate cut as rather small, and demanded much bigger reductions to boost economic growth. The next Fed chair will almost certainly be someone more aligned with the White House, someone willing to prioritize the administration's agenda. That transition introduces yet another layer of uncertainty into an already murky picture. The rules of the game might change. The people making decisions will change. The priorities could shift dramatically. For anyone with money in the markets, this is absolutely critical information. The Fed you know today may not be the Fed you're dealing with tomorrow. Let's dig into inflation, because this is the hawks' primary battlefield, and honestly, they have a compelling case. Inflation has simply not behaved the way anyone expected. The Fed wanted it back at 2%. That's always the goal. The North Star of monetary policy. But inflation has had other plans. It came down from the terrifying highs of 2022. That was the easy part. Getting from 9% down to 4% required patience and some painful rate hikes, but it happened. Getting from 4% down to 2%, that requires something entirely different. It requires luck, and luck is not a strategy you can count on. Here's the fundamental problem. Inflation is sticky. Once it embeds itself in the fabric of the economy, it resists change with remarkable stubbornness. Workers start expecting higher wages and won't accept anything less. Businesses plan for higher costs and raise prices preemptively. Landlords expect higher rents because, well, everything else is more expensive. These expectations become self-fulfilling prophecies. People raise prices because they expect everyone else to raise prices, creating a feedback loop that's incredibly difficult to break. The Fed has a technical term for this phenomenon: inflation expectations. When those expectations are anchored, when people believe the Fed will keep prices stable, inflation tends to remain calm and manageable. But when expectations start to drift, when people lose faith that inflation will come back down, it becomes unpredictable and dangerous. Right now, expectations are drifting. Consumers still feel that prices are too high, and they're adjusting their behavior accordingly. Businesses are still planning for continued cost increases. The psychological reset that the Fed desperately needs simply hasn't happened yet. And there's another complicating factor that makes this even messier: tariffs. The current administration has implemented significant tariffs on imported goods, and those tariffs directly raise costs for American businesses and consumers. Higher import costs mean higher prices at the store. Higher prices mean higher inflation readings. Powell acknowledged this awkward reality in his press conference, essentially saying that inflation looks fine if you strip out the impact of tariffs. But here's the thing. You can't strip out tariffs. They exist. They're affecting prices right now, today, and they're making the Fed's already difficult job significantly harder. So where does inflation actually stand? Powell's own words described it as somewhat elevated. Central bankers speak for above our target and still a problem. The job isn't done. The hawks see this with absolute clarity, and they're arguing for caution. Why would you cut rates when inflation is still running hot? Why would you add stimulus to an economy where prices are already uncomfortably high? The doves counter with trend analysis. Yes, inflation is elevated, but it's lower than it was last year. The direction is correct, even if the pace is frustrating. Their argument is to be patient. Let the previous rate hikes continue working through the system. Don't over-tighten and inflict unnecessary economic damage. Both arguments carry genuine merit, which is precisely what makes this situation so agonizing. The data supports multiple interpretations, and the Fed has to pick just one. Now let's examine the other side of this equation, the labor market. This is where the doves plant their flag, and their concerns are equally legitimate. Job growth has unquestionably slowed this year. The numbers don't lie. Employers are hiring fewer workers, job gains have weakened month after month, and the unemployment rate has edged up to 4.4% as of September. Now, 4.4% is still low by historical standards. We've certainly seen much worse. But here's the thing. The direction matters far more than the absolute level. Think about it this way. A plane cruising at 30,000 feet is perfectly safe. A plane descending rapidly at 30,000 feet is a completely different situation. What matters is the trajectory, and right now, the labor market's trajectory is pointing down, not crashing, not in free fall, but descending steadily in a direction that should concern anyone paying attention. What really worries the doves is that the Fed's aggressive rate hikes from previous years are still working their way through the economic system. Higher interest rates make borrowing expensive, which causes businesses to delay expansion plans and postpone hiring decisions. Some companies start considering layoffs. This process doesn't happen overnight. It takes time, often 6 to 12 months or longer. The full impact of past Fed decisions hasn't fully materialized yet, and when it does, the labor market could look considerably worse than it does today. Powell himself acknowledged this concern when he said, "Conditions might be weaker under the surface." That phrase deserves careful attention, under the surface. The headline unemployment number looks acceptable, but dig beneath it and you find troubling cracks. Job seekers are taking longer to find new positions. Companies are posting fewer openings. The labor market is cooling in ways that don't always show up in the top-line statistics. The doves are essentially arguing for insurance. Cut rates now to prevent worse outcomes later. Don't wait until unemployment spikes dramatically, because by that point, it's already too late. Monetary policy operates with significant lags. If you wait for crystal clear evidence of a serious problem, you've already waited far too long to address it effectively. And there's yet another complication layered on top of all this. The government shutdown delayed critical employment data. The Fed made its December decision without complete information. They couldn't clearly see what happened to jobs in October or November. They were essentially flying blind through fog, forced to make a trillion-dollar decision without being able to see the terrain below them. How do you choose the right path when you literally cannot see the road ahead? Now we arrive at the heart of the matter, the scenario that keeps economists awake at night. Stagflation. The word itself is a portmanteau, combining stagnation and inflation, and it describes an economic nightmare, the worst of both worlds arriving simultaneously. Prices rising relentlessly while the economy grinds to a halt. Jobs disappearing while the cost of living keeps climbing. It's the economic equivalent of being attacked from both sides with nowhere to hide. Let me explain exactly why stagflation is so terrifying. Under normal circumstances, the Fed has a reliable playbook. If inflation runs too hot, they raise interest rates. Higher rates cool consumer spending. Spending decreases, and prices eventually stabilize. Problem solved. If unemployment rises too high, they cut interest rates. Lower rates encourage borrowing. Borrowing stimulates spending. Businesses see increased demand and start hiring again. Problem solved. These tools work because typically economic problems arrive one at a time. You either have an inflation problem or an employment problem, and the appropriate response is clear. Stagflation completely breaks this logic. Both problems show up at once, and suddenly every tool in the Fed's arsenal becomes a double-edged sword. Cut rates to help employment, and you pour fuel on the inflation fire. Raise rates to fight inflation, and you accelerate job losses. There's no good move available, no elegant solution, no clear path forward. The Fed becomes trapped, and every choice they make inevitably makes something worse. This isn't some theoretical scenario cooked up by academic economists. It actually happened. The 1970s taught America exactly how devastating stagflation can be. Oil shocks sent energy prices soaring. Economic growth stalled out. Unemployment climbed steadily higher. And inflation? It climbed right alongside unemployment, defying the conventional wisdom that said these two problems couldn't coexist. The Fed struggled for years, trying everything they could think of. Nothing worked cleanly. Eventually, Paul Volcker took the helm and made the brutal decision to raise rates dramatically, crushing inflation, but also triggering a severe recession that threw millions of Americans out of work. It was incredibly painful medicine. but it was the only medicine that worked. Are we heading toward a repeat of that nightmare? The honest answer is, we don't know. The conditions are certainly concerning. Inflation remains elevated and stubbornly sticky. Job growth is weakening month after month. Both metrics are moving in the wrong direction, the exact pattern that historically precedes stagflation. But there are important differences that offer some hope. Today's inflation, while troublesome, is significantly lower than the double-digit readings of the 1970s. The labor market, despite its slowdown, remains stronger than it was back then. And crucially, the Fed has decades more experience understanding these dynamics and responding to them. These factors provide some comfort, not certainty, but comfort. Here's what investors need to internalize. Stagflation is what's called a tail risk. It's not the most likely outcome. Most economists still believe a soft landing is achievable, but it's a possible outcome, and the probability isn't zero. The 3 dissenting votes at the December meeting reflect this deep-seated anxiety. The hawks are staring at the inflation side of the monster. The doves are fixated on the employment side. They're all looking at the same terrifying creature from different angles. The Fed's job now is to thread an incredibly narrow needle, cut enough to support employment without cutting so much that inflation reignites. The margin for error has become razor-thin. One wrong move creates cascading consequences, and those consequences take months to become visible. By the time you realize you've made a mistake, it's far too late to easily correct course. This is why the coming months matter so enormously. The incoming data will reveal which direction we're actually heading, toward the relief of a soft landing or toward something considerably more painful. Here's something that most people fundamentally misunderstand about monetary policy. It operates with a substantial delay. When the Fed changes interest rates today, the economy doesn't feel those effects for months, sometimes 6 months, sometimes a full year, sometimes even longer. Think about how rate changes actually propagate through the system. The Fed announces a cut. Banks receive the news and begin adjusting their own rates. Mortgage lenders update their product offerings. Credit card companies revise their terms and conditions. All of this takes weeks. Then consumers start to notice. They see better refinancing opportunities. They take on new debt. They adjust their spending patterns accordingly. This phase takes months. Finally, businesses respond to the changed consumer behavior. They see shifting demand patterns. They reconsider their hiring plans. They modify their capital investment strategies. This takes additional months. The complete transmission cycle typically runs somewhere between 6 and 12 months, sometimes even longer for major policy changes. So when the Fed cut rates in December 2025, the real economic impact won't fully arrive until mid-2026. By that point, circumstances could have changed dramatically. New data will have emerged. New problems will have surfaced. The decision that made sense based on today's information may turn out to address yesterday's problem while inadvertently creating tomorrow's crisis. This lag effect creates a fundamental philosophical challenge for central bankers. The Fed isn't setting policy based on where the economy is right now. They're setting policy based on where they believe the economy will be 6 to 12 months in the future. They have to predict what's coming, and forecasting is extraordinarily difficult even for brilliant people with sophisticated models and access to vast amounts of data. The economy surprises everyone eventually, including, and perhaps especially, the people paid to anticipate its movements. Consider the Fed's current predicament. They've now cut rates 3 times in 2025. Those cuts are still propagating through the financial system. The full effect hasn't materialized yet. Should they cut more? That depends entirely on what happens next. But they can't see what happens next with any certainty. They can only make educated guesses based on incomplete information and hope they're roughly correct. Powell essentially acknowledged this profound uncertainty when he said the Fed is well-positioned to wait. In central banker translation, that means we want to pause, observe how our previous actions are affecting the economy, see where inflation and employment actually land, and then, and only then, decide on next steps. But this waiting game carries its own set of risks. Wait too long and the economy might weaken more than necessary, potentially tipping into recession. Move too soon and you might overstimulate, reigniting the inflation you worked so hard to contain. The timing is absolutely everything in monetary policy, and that timing is based on forecasts and predictions that frequently turn out to be wrong. Let's take a step back and analyze the broader rate cycle, because understanding where we sit in this cycle helps make sense of everything else. The Fed began aggressively raising rates in 2022 when inflation was surging out of control. They moved quickly and decisively, pushing rates from near zero all the way above 5%. An enormous tightening campaign that lasted roughly 2 years. The goal was simple and singular: slow down the economy enough to crush inflation before it became permanently embedded. Now we've entered a fundamentally different phase, the easing cycle. Rates are coming down. 3 cuts delivered so far in 2025, bringing rates from around 4.5% down to 3.5%. The question on everyone's mind: how much further will this go? To answer that question intelligently, you need to understand the concept of the neutral rate. This is the theoretical interest rate level at which monetary policy is neither stimulating the economy nor restricting it. The Goldilocks zone where everything is in balance. Not too hot, not too cold, just right. The problem is that nobody, not even the Fed, knows precisely where neutral actually sits. Economists typically estimate it somewhere around 2.5 to 3%, but these estimates vary considerably depending on the model and assumptions used. The Fed itself admits significant uncertainty about the exact location of neutral. Currently, rates stand at 3.5%, above most estimates of neutral. This means monetary policy remains somewhat restrictive, still applying mild braking pressure to the economy. The Fed could theoretically cut rates further and still remain in neutral territory, or they could choose to pause at current levels and observe how things develop. Market forecasters hold divergent views on what comes next. Some expect 2 additional cuts in 2026, which would bring rates down to around 3%, right at the consensus neutral estimate. Others anticipate a prolonged pause, arguing that persistent inflation risks warrant patience and caution. The truth is that nobody knows for certain, and anyone claiming otherwise is probably trying to sell you something. Here's what actually matters for investors. The general direction is clear. Rates are heading lower over time, but the speed of that descent remains genuinely uncertain. Rapid cuts would signal that the Fed is worried about economic weakness. Slower, more measured cuts would indicate greater concern about inflation resurgence. The pace of rate changes tells you what the Fed fears most at any given moment. Watch the incoming economic data very closely. Strong inflation readings will slow the pace of cuts. Weak employment data will accelerate them. The Fed has explicitly declared itself data-dependent at this juncture, meaning each new economic report has the potential to shift the policy calculus significantly. One final point worth emphasizing: the rate cycle affects virtually everything in the financial universe. Stock valuations rise and fall with interest rate expectations. Bond prices move inversely with rates. Housing affordability depends heavily on mortgage rates, which follow Fed policy. Business investment decisions hinge on borrowing costs. Even currency exchange rates respond to interest rate differentials between countries. When rates change, asset prices throughout the economy change with them. Understanding where we are in the rate cycle won't let you predict markets perfectly. Nothing can do that. But it will help you make sense of why markets are moving the way they are. Let's turn our attention specifically to Jerome Powell and what his recent statements reveal about his thinking. The phrase that stood out most prominently from his December press conference: "We are well positioned to wait and see how the economy evolves." This is classic Fed speak, and the translation is straightforward. They're signaling a pause. Powell was essentially telling markets that December might be the last rate cut for a while. Not a firm commitment, but a strong and deliberate hint. He took care to emphasize everything the Fed has already accomplished this year. 3 rate cuts, a cumulative 75 basis points of easing, significant support already delivered to the economy. His underlying message was unmistakable. We've done our part. Now we step back and watch. But Powell also displayed something unusual: visible frustration with circumstances beyond his control. The government shutdown had complicated everything, delaying the release of critical economic data that the Fed relies upon for informed decision-making. Inflation numbers since October? Largely incomplete. Employment figures? Significant gaps in the data. He mentioned the shutdown repeatedly throughout the press conference, which is quite unusual. Fed chairs typically avoid blaming external factors so openly and directly. Reading between the lines, Powell clearly wanted more information before making this decision. He was forced to act without full visibility into what's actually happening in the economy, an uncomfortable position for anyone, let alone someone responsible for managing trillions of dollars in economic activity. The political dimension adds another layer of complexity to Powell's situation. Trump has criticized him repeatedly and publicly, calling him names, disparaging this rate cut as insufficient, demanding much larger reductions to stimulate growth. Powell must somehow navigate this constant political pressure while maintaining the Fed's cherished independence from electoral politics. It's an exceptionally delicate balancing act, made more difficult by the knowledge that his days in the chair are numbered. His term expires in mid-2026, possibly May or June. That's mere months away in the context of monetary policy, where decisions take years to fully play out. Powell knows his time is limited, and he's made clear that leaving the economy in good shape matters deeply to him. His legacy is on the line with every remaining decision. This creates a fascinating psychological dynamic. Powell may be reluctant to make any bold or aggressive moves in his final months. He doesn't want to leave a mess for his successor to clean up, but he also doesn't want to be blamed for doing too little if the economy stumbles. Every decision he makes from this point forward carries extra weight and extra scrutiny. Pay close attention to what Powell does in his remaining meetings. Those decisions will shape his historical legacy, and more importantly for you, they'll shape the economic environment in which you're investing your money. What's actually going to happen next year? Let's walk through the realistic scenarios, because understanding the range of possibilities is far more valuable than pretending you know which one will occur. Scenario 1. The soft landing. This is the optimistic case that most analysts currently favor. Inflation continues its gradual drift downward toward the Fed's 2% target. The labor market stabilizes without significant deterioration. Economic growth remains positive, albeit modest. The Fed delivers perhaps 2 more quarter-point cuts, bringing rates to around 3%. Markets celebrate the successful navigation of a tricky situation. Investors breathe a collective sigh of relief. The economy muddles through without major damage. Not a triumphant victory, but certainly not a disaster. Scenario 2, inflation resurges. This is what keeps the hawks awake at night. The rate cuts prove to have been premature and excessive. Inflation rebounds back above 3%, erasing much of the progress made over the past 2 years. The Fed is forced to reverse course awkwardly, pausing further cuts and potentially even hiking rates again. Markets react badly to this policy whiplash, with significant volatility across asset classes. The Fed's credibility takes a major hit for having moved too aggressively too soon. Scenario 3. Recession materializes. This is the scenario that haunts the doves. The labor market deteriorates more quickly than anticipated, with unemployment jumping significantly higher. Consumer spending, which drives roughly 70% of the American economy, begins to collapse. The Fed scrambles to cut rates aggressively, but monetary policy lags mean they're fighting yesterday's war. The economy officially enters recession, painful and disruptive, but typically temporary. Eventually, recovery follows, though it may take longer than anyone hopes. Scenario 4. Stagflation arrives. This is the true nightmare scenario, the economic equivalent of a perfect storm. Inflation remains stubbornly elevated despite slowing growth. Jobs disappear even as prices keep climbing. The Fed finds itself with no good options, every tool in their arsenal making something worse. They struggle for years, unable to find the right balance. Markets experience prolonged, grinding volatility with no clear direction. This would be a replay of the 1970s misery that scarred a generation of investors. Which scenario is most probable? Professional forecasters generally lean toward the soft landing as their base case, but their confidence levels are notably lower than usual. The dissenting votes at December's meeting reflect this elevated uncertainty. The honest truth that nobody wants to admit: we simply don't know how this plays out. What we do know is that the Fed currently projects 2 additional cuts in 2026, likely targeting March and June. But these projections change constantly. They get updated at every meeting as new data arrives and reshapes the committee's thinking. The major wild card in all of this is the incoming Fed chair. Trump will appoint Powell's successor, and that individual will inherit this entire constellation of challenges. Their personal philosophy and policy preferences will matter enormously. A dovish chair would likely push for more aggressive rate cuts, while a hawkish chair would counsel patience and restraint. The leadership transition itself introduces yet another source of uncertainty into an already uncertain picture. For investors, the message emerging from all this analysis is straightforward. Don't bet everything on any single scenario playing out. Prepare your portfolio for multiple possibilities simultaneously. Diversification isn't just a nice-sounding investment principle. In times like these, it's genuinely a survival tool. Let's talk about market psychology, because financial markets don't operate on pure rationality. They run on human emotion, narrative construction, and herd behavior. And right now, the dominant narrative is thoroughly confused. When the Fed speaks with unified confidence, markets feel reassured. They can price assets based on clear expectations about the path forward. Everyone more or less agrees on where things are heading. Trading patterns become relatively orderly. Volatility remains contained. It's a comfortable environment for making investment decisions. When the Fed publicly fractures, that confidence shatters along with it. Investors immediately start asking difficult questions. Who's actually right here? The hawks or the doves? Which scenario should I be pricing into my portfolio? This uncertainty breeds hesitation. Hesitation leads to volatility. Volatility generates fear, and fear produces even more volatility. The whole thing becomes a self-reinforcing negative feedback loop. There's a term for this psychological trap that markets sometimes fall into: the uncertainty trap. Markets get stuck oscillating between competing narratives with neither bulls nor bears able to claim decisive victory. Both sides can point to compelling evidence supporting their worldview. The result is choppy, directionless, frustrating price action that makes everyone feel like they're getting it wrong. The 3 dissenting votes at December's meeting amplified this trap significantly. They sent an unmistakable signal to every market participant, even the experts, the people with access to the best data, the most sophisticated models, decades of combined experience. Even they can't agree on what's happening or what should be done about it. If the Federal Reserve doesn't have the answer, how can anyone else possibly claim to know? This realization is humbling, but it's also potentially paralyzing. Human psychology handles uncertainty extraordinarily poorly. We crave certainty at a deep, almost biological level. We desperately want someone authoritative to tell us what happens next, to give us a roadmap we can follow confidently. When no one can provide that certainty, we tend to either freeze completely or panic and make rash decisions. Both responses typically damage long-term investment returns. The smarter response, though emotionally more difficult, is fundamentally different. Acknowledge the uncertainty explicitly rather than pretending it doesn't exist. Accept intellectually that multiple outcomes remain genuinely possible. Position your portfolio accordingly, with flexibility and optionality rather than concentrated bets. And critically, don't pretend to possess knowledge that you simply cannot have. Here's the psychological trap that ensnares many investors during periods like this. They pick a narrative and commit to it completely. All in on the soft landing, or all in on recession, or all in on inflation resurgence. This total commitment feels emotionally satisfying. It provides a sense of false certainty in an uncertain world, eliminates the discomfort of ambiguity, but it creates enormous concentrated risk. When your chosen narrative breaks, and eventually some narrative always breaks, your portfolio breaks along with it. The Fed's visible division is actually useful information if you know how to interpret it correctly. It's telling you, loudly and clearly, that flexibility and adaptability matter far more than strong conviction right now. So what does all of this actually mean for you and your money? Let me share some guiding principles, not predictions, not specific investment advice, just frameworks for thinking more clearly about an unclear situation. First and most importantly, respect the uncertainty. The Fed is divided precisely because the economic situation is genuinely ambiguous and difficult to read. Don't fall into the trap of pretending to have answers that even the world's foremost monetary policy experts lack. Intellectual humility isn't just a virtue in times like these. It's a practical tool for protecting your capital from overconfident mistakes. Second, pay extremely close attention to incoming economic data. Employment reports matter now more than they have in years. Inflation readings will move markets significantly in either direction. These data releases directly shape Fed decisions, and Fed decisions directly shape asset prices throughout the economy. The causal chain is short and direct. Understand it, and you understand why markets are reacting the way they are. Third, train yourself to think in probabilities rather than certainties. A soft landing is possible, maybe 40 or 50% likely. Recession is possible, perhaps 20%. Stagflation is possible, maybe 10 or 15%. Inflation resurgence is possible, another 15 or 20%. Whatever numbers you assign, the key is to then ask yourself, is my current portfolio genuinely prepared for all of these scenarios? If one particular outcome would devastate your financial situation, you probably need to adjust your positioning. Fourth, honestly assess your time horizon. If you need to access your money within the next 6 months, this elevated uncertainty matters enormously for your decisions. If your investment horizon stretches 10 or 20 years into the future, it matters considerably less. Short-term volatility, however dramatic it feels in the moment, tends to fade into statistical noise over longer time periods. Make sure your investment strategy matches your actual timeline, not some theoretical timeline you wish you had. Fifth, actively resist the addiction to prediction, the urge to forecast the future, to call the top, to call the bottom, to be the person who saw it coming, is powerful and seductive. Almost everyone fails at it. The rare few who occasionally succeed usually got lucky rather than skillful. Though they'll rarely admit it. Focus on your process and risk management rather than trying to predict unpredictable events. Sixth, never forget about policy lags. The rate cuts the Fed has already delivered in 2025 will continue affecting the economy throughout 2026 and potentially beyond. The economic conditions you observe today largely reflect policy decisions made months or even years ago. To understand where we're heading, you need to think ahead rather than fixating solely on the present moment. Finally, cultivate and maintain genuine curiosity. Keep learning, keep reading, keep questioning your assumptions. The economy evolves continuously, and strategies that worked brilliantly in the past may fail spectacularly in the future. Rigid, inflexible thinking is genuinely dangerous in a dynamic economic environment. Flexible, adaptive thinking survives and eventually thrives. This Fed decision, dramatic as it was, represents just one moment in a long, ongoing economic journey. More decisions will follow, more data will emerge, more surprises will occur. The story continues to unfold, chapter by chapter. Your job as an investor isn't to predict how the story ends. That's impossible. Your job is to stay in the game long enough, with enough resources intact, to eventually benefit from however things ultimately play out. Let me wrap up everything we've covered in today's discussion. The Federal Reserve cut interest rates in December, their third cut of the year. 3 members of the committee publicly disagreed with that decision, marking the most divided vote in 6 years. That division tells us something important. The path forward for the American economy is genuinely unclear, even to the people with the most information and expertise. Inflation remains stubbornly sticky, refusing to fall smoothly to the Fed's 2% target. The labor market is softening, with job growth slowing and unemployment creeping higher. The risk of stagflation, that dreaded combination of rising prices and falling employment, exists and cannot be dismissed. Policy lags complicate every decision, as actions taken today won't show their full effects for months to come. Powell has signaled that a pause in rate cuts is likely ahead. He wants time to wait and observe how the economy responds to the substantial easing already delivered. His term ends soon, within months, and a new chair, likely with different priorities, will take over. More uncertainty inevitably follows. For investors, the central lesson is deceptively simple, but genuinely difficult to implement. Prepare rather than predict. Diversify your portfolio across multiple possible scenarios rather than betting heavily on any single outcome. Stay humble about the limits of your knowledge, and everyone else's knowledge for that matter. The experts are divided for excellent reasons. The economic situation is authentically complex and resistant to easy analysis. This is emphatically not a time for bold, concentrated bets. This is a time for careful, thoughtful positioning, for building portfolios that can withstand multiple scenarios rather than ones optimized for a single predicted outcome. The fog that obscures the economic landscape will eventually lift. New data will arrive and provide clarity. Until that happens, patience isn't just a virtue, it's your single greatest asset. Thank you for listening to this analysis. If it helped you think more clearly about these complex issues, consider subscribing so you don't miss future discussions. Share this with someone in your life who could use some perspective on what's happening in the economy. And always remember, in deeply uncertain times like these, genuine understanding beats confident guessing. Every single time.